When a crisis hits, your brain's survival instincts take over. In a matter of seconds, biological chemical responses force you to react. And while those reflexes kept our ancestors alive, today they cause highly intelligent people to make fatal financial decisions. We see the wreckage across completely different industries. A tech startup burns through $1 million building a product nobody wants. A corporate board holds on to a toxic executive until the team fractures. A retiree trains their portfolio exactly when they should stay invested. This diagram compares the failure metrics of two entirely different disciplines. On the left, we see that 68% of custom software projects fail to meet their original goals. On the right, we see the average investor underperforming the stock market by a massive 8.48% every single year. Software and stocks are different worlds, but the data patterns are eerily similar. When we look past the technical jargon, we see the same sequence of decision-making errors occurring weeks before a single line of code is written or a single share is sold. These losses are an invisible tax, a literal financial penalty paid to biology. Companies and individuals bleed capital because they fall into three distinct psychological traps. Identifying and mastering these three traps is the singular difference between building a sustainable business and watching your resources bleed away through preventable errors. The first biological hurdle is the hubris trap. Companies eager to start building skip the initial discovery phase and jump straight into development. Ego tells founders they already know what the market needs, leading them to build entirely on unchecked assumptions. The math on this error is brutal. Skipping the discovery phase routinely doubles total project costs. Features are built, scrapped, and rebuilt. Months of runway are wasted simply because founders refuse to invest 5 to 10% of their budget in upfront planning. The second hurdle is the avoidance trap. In corporate hiring, executives frequently keep underperforming or toxic leaders on the payroll simply to avoid interpersonal conflict. They trade the long-term health of the company for short-term emotional comfort. This diagram highlights the compounding cost of that hesitation. Replacing a single bad executive costs 1.5 to 2 times their annual salary. Factor in lost productivity, team turnover, and missed revenue, and that desire to avoid an awkward conversation becomes a 6-figure mistake. When leadership prioritizes internal harmony over strategic clarity, businesses stall. As the text states, many top teams hide their differences rather than confront hard trade-offs directly. Leadership devolves into design by committee. Progress halts because multiple stakeholders must agree, reversing decisions while the budget burns. Avoiding conflict and skipping discovery are not signs of laziness. They are mathematically destructive ego preservation tactics. The third and most expensive trap is panic. It triggers when oil prices jump, the jobs market stumbles, or geopolitical tensions rise. The news feels dangerous, and the instinct to protect your assets takes over. Behavioral economics calls this loss aversion. The human brain processes a financial loss approximately twice as intensely as an equivalent gain. A falling portfolio triggers the exact same neural response as physical danger. You feel an immediate, overwhelming urge to stop the pain. Data proves average investors trail the market by 8.48% annually. They sell good funds when scared. This stops immediate pain but locks you out of the recovery. The best days occur right after the worst. Sitting in cash, the rebound has already passed. We call this the false safety trap. Moving entirely to cash feels deeply responsible during a crisis. But with inflation steadily eating away at value, a portfolio that doesn't grow guarantees a total loss of purchasing power over a 20-year retirement. Seeking emotional comfort during a crisis is the reliable way to guarantee permanent, irreversible financial ruin. You cannot outthink your own biology. The stress response will happen, but you can build structural systems that render your emotional reactions completely powerless. This visual represents step 1, the buffer. You must keep 12 to 24 months of essential living expenses in stable, liquid assets entirely outside of your investment portfolio. The physical buffer eliminates the need for forced panic selling. If you don't need to liquidate your stocks to pay next month's bills, a market decline is just an event to monitor, not a threat to your survival. Step 2 is pre-commitment. The best time to decide how you will act during a market crash is when the market is calm. Write a strict plan, establish rebalancing conditions, and let the document make the decisions when the stress hits. In the business world, pre-commitment means forcing a formal discovery phase before coding starts and officially designating a single uncompromising decision-maker before a project launches. Across every industry, the final rule remains the same. Strict operational process must always supersede emotional reaction. The top 1% of investors and founders do not possess better foresight than the rest of us. They simply build rigid systems that make predicting the future and reacting to fear completely irrelevant.